Welcome to today's stock spotlight on Kroger Company, NYSE, KR. The current sentiment is short-term bearish, but long-term bullish. After closing around $62.71, the sharp early December pullback looks more like a market overreaction than a true reflection of Kroger's fundamentals. Let's break it down. Technical analysis. Price action. Shares dropped from a high of $69.89 to a recent low near $62.71. Moving averages. The 10-day SMA crossed below the 50-day SMA, confirming bearish momentum. Support. Watch the $60.96 zone, a critical level that could form a double bottom. Volume. Heavy selling volume suggests capitulation, often a late-stage correction signal. RSI. At 36.44, Kroger is nearing oversold territory. Historically, stable companies tend to rebound once RSI dips this low. Fundamental analysis. Despite the sell-off, Kroger's fundamentals remain strong. Revenue miss explained. The headline miss was due to fuel sales and divestitures. Adjusted sales actually grew 2.6% year-over-year. Margins and earnings. Adjusted FIFO profits rose 700 basis points, and EPS of $1.05 beat estimates by nearly 200 basis points. Digital growth. Online sales surged 17%, validating Kroger's pivot toward on-demand partnerships. Share buybacks. A 10% reduction in share count through accelerated repurchases signals management's confidence in undervaluation. Outlook and predictions. Short term, 1 to 2 weeks, expect volatility, with a likely test of the $60.96 support. A rebound toward the 10-day SMA at $65.74 is probable once selling pressure eases. Long term, 1 to 3 months, fundamentals point to recovery. As investors refocus on earnings strength and digital growth, Kroger could return to the $68-$69 range, supported by the buyback program. Conclusion. In summary, this looks like a buy-the-dip opportunity. The market punished Kroger for external factors like fuel prices, while ignoring strong internal execution. With oversold technicals and bullish fundamentals, Kroger may be poised for a rebound once the dust settles. Today we're analyzing a classic bearish reversal signal, the 3 black crows pattern, spotted on Kroger's chart. This formation is a warning sign that sellers have taken control. 3 black crows. The pattern shows 3 consecutive long red candles, each opening within the prior candle's body and closing lower. On Kroger's chart, this stair-step decline highlights several days where sellers dominated from open to close. It reflects a sharp sentiment shift, confirming investor concerns over earnings and consumer caution. Supporting pattern, bearish Marubozu. Some of these candles are bearish Marubozu, long red bodies with almost no wicks. That means buyers never managed to push prices back up during those sessions. Combined with heavy red volume bars, it signals strong institutional selling, not just retail traders. Gap down. We also see signs of a gap down, or falling window, likely triggered by overnight earnings news. This shows extreme negativity, as trading skipped over entire price levels between the prior close and the new open. Summary and implication. Together, these patterns confirm aggressive, decisive selling. Yet, with Kroger's RSI near 36, the stock is now oversold. Historically, 3 black crows often mark the final flush before stabilization. Traders will be watching for a hammer or doji candle next, signals that selling pressure may finally be exhausted. Disclaimer: I am not a financial advisor. This video is for educational and entertainment purposes only. Please do your own research before making any investment decisions.